What's up everyone, Charlie here. It's getting to that time where everything's simmering down, everything's getting back to where they were pre-COVID, before all the leverage was given to the banks and it was just a buy spree. And now we're getting back to those levels where things may need to be evaluated again. So if that's the case, you're going to need to know about earnings and the long straddle option strategy. Two things that will come in very much handy for you in the upcoming months. So let's begin. So earnings, why is it important? Well, earnings can be amongst one of the most profitable opportunities, in my opinion, in the stock market, simply because on a company's earnings report, you have new information that comes out about the company, which whenever there's new information, the price usually reacts. This is one of the few times that we see volatility, especially in today's market, with volatility locked up in the repo market. Next, the report is scheduled ahead of time. You know it's coming for the most part, so you can plan for it. 3, it's one of the very few scenarios where Wall Street can be surprised and incorrect. 4, you can study earnings and grasp where a company stands, and also study prior to earnings and prior earnings reactions that happened in the past from Wall Street. So it's very studyable. Very studyable. Now, obviously, past performance doesn't dictate future results, but you can still study it nonetheless. Now, let's look at what mechanics from company earnings affect the stock pricing come earnings day. There's 5 things that I feel that is important. The first one being price to earnings ratio. You probably heard of it, usually referred to as PE ratio. There's also price to book ratio, debt to equity ratio, free cash flow, and then one of the more important, in my opinion, PEG ratio. So if there's 2 to pay attention to in this video, it would be price to earnings ratio and the PEG ratio. And for GME holders, free cash flow, pretty important. So first, let's look at price to earnings ratio. The price to earnings ratio, referred to as the PE ratio, is a metric that helps investors determine the market value of a stock compared to the company's earnings. In short, the PE ratio shows what the market is willing to pay today for a stock based on its past or future earnings. The PE ratio is important because it provides a measuring stick for comparing whether a stock is overvalued or undervalued. A high PE ratio could mean that a stock's price is expensive relative to earnings and possibly overvalued. Conversely, a low PE ratio might indicate that the current stock price is cheap relative to earnings. So the formula for this is price per share divided by earnings per share, or EPS, which is oftentimes predicted ahead of time by the analyst. So for example, if GameStop had a forward or an EPS estimate of, let's just say for argument's sake, 20 cents per share, and let's just say, to make it easy, GameStop was trading at $100, then you do that simple math and you can see where they stand from a valuation perspective. So, useful metric for evaluating relative attractiveness of a company's stock price compared to the firm's current earnings. PE ratio is the price of an investor pays for $1 of a company's earnings or profit. Along with due diligence, examining PE ratio can help you avoid getting swept away in bubbles, manias, and panics. Now, while that may be true, we're going to stick to it just from a reaction standpoint. Because remember, in the market, whenever things happen like this, whenever there's a surprise or a reaction to something, it's often an overreaction, and that's where profit can be made. Now, since the ratio determines how much an investor would have to pay for each dollar in return, a stock with lower PE ratio relative to companies in its industry costs less per share for the same level of financial performance than one with a higher PE ratio. Let me say that again. So a stock with a lower PE ratio relative to companies in its industry costs less per share for the same level of financial performance than one with a higher PE ratio. So value investors can use the PE ratio to help find undervalued stocks. Now, PE ratio does have limitations, as does everything else in the market. They should not be used, and PE ratios should not be used solely to make financial decisions. Nothing, in my opinion, is great enough to warrant a decision as far as a financial decision in the market based on itself alone. So keep in mind, these are opinions of Wall Street, and as a result, due to that fact, earnings can be hard to predict since past earnings don't guarantee future results, and analysts are often wrong. So keep that in mind. Also, the PE ratio doesn't factor in earnings growth, but that is why I like the PEG ratio, because that's where that comes into play. Now, this is why you should use the PE ratio as a benchmark and always do your own DD on company financial performance before heading into earnings. Don't use what Wall Street says as a matter of fact. Use what they say as a benchmark. Go research it yourself. See if they're off. See if they made a mistake. Because again, they're only human, and as we know, they get it wrong a lot. You'd be surprised how many times they do get it wrong, and you can profit off of this mistake. And another thing, get to know your sectors and industries. It is important. You need to know if you have a stock and you're bullish or bearish on it, whatever. You need to know what sector it's in and what industry it's in. Just knowing this knowledge alone is so useful, because number one, PE ratios are useful for companies or comparing companies within their own industries, not in different industries. So if you're comparing, household durables against consumer cyclical sector, or if you're comparing oil and gas against airplanes and airports, two different sectors, it may not be the best thing to do. Or if you're comparing, real estate, equity real estate to software and hardware from tech sector, or, education and training from consumer defensive, apples to oranges. And again, this is why I have the Discord set up this way, organized by sector and industry, with tickers manually inputted with feeds on them, because it helps you learn what all this is. When you get a notification from a stock ticker and it comes out of a specific channel relative to its own industry and sector, you'd be surprised how quickly you pick it up. A matter of days. But again, free to use for the public. Come check it out if you like. It helps with just the repetition and the knowledge of the sectors. But anyways, let's get on to the PEG ratio. So the PEG ratio is the price to earnings to growth ratio. It's a modified version of the PE ratio that also takes earnings growth into account, unlike the PE. So the PE ratio doesn't always tell you whether or not the ratio is appropriate for the company's forecasted growth rate. The PEG ratio measures the relationship between the price and earnings and growth rate. So the PEG ratio provides a more complete picture of whether a stock's price is overvalued or undervalued by analyzing both today's earnings and the expected growth rate. Typically, a stock with a PEG of less than 1 is considered undervalued since its price is low compared to the company's expected earnings growth. A PEG greater than 1 might be considered overvalued since it might indicate the stock price is too high compared to the company's expected earnings growth. Since the PE ratio doesn't include future earnings growth, the PEG ratio provides a more complete picture of a stock's valuation. The PEG is an important evaluation metric since it provides a forward-looking perspective, which again is the difference between that and the PE. So now we have price to book, which we'll get into the less important things in my opinion. I don't personally trade off of this. I trade off more of the first two, but everyone's different. You may trade off this, find a way to do it. I'm just going to go over it real quick. The price to book formula is price of the market, or market price per share, divided by the book value per share. Now the price to book, or PB ratio, otherwise referred to, measures whether a stock is over or undervalued by comparing the net value of a company to its market capitalization. Essentially, it's dividing a stock's share price by its book value. The PB ratio is a good indication of what investors are willing to pay for each dollar of a company's net value. The reason the ratio is important to value investors is that it shows the difference between the market value of a company's stock and its book value. The market value is the price investors are willing to pay for the stock based on expected future earnings. However, the book value is derived from a company's net value and is a more, in my opinion, conservative and realistic way to measure a company's worth. But again, I don't really use it, so it is what it is. Whoops. Come on, PowerPoint. Now we have debt to equity ratio, which is a stock metric that helps investors determine how a company finances its assets. So the ratio shows the proportion of equity to debt a company is using to finance its assets. A low debt to equity ratio means the company uses a lower amount of debt for financing versus shareholder equity. A higher debt to earnings ratio, or debt to equity ratio rather, means the company derives more of its financing from debt relative to equity. Now, too much debt can pose a risk to company if they don't have the earnings or cash flow to meet its debt obligations. As with the previous ratios, the debt to equity ratio can vary from industry to industry. More reason to learn your industries and sectors. A high debt to equity ratio doesn't necessarily mean the company is run poorly. Often, if they have the earnings for it, debt is used to expand operations and generate additional streams of income. So not all debt is bad debt. Some industries with a lot of fixed assets, like auto and construction, typically have higher ratios than companies in other industries. It's just the nature of the market. Industries vary. So last we have free cash flow, which for GME investors, this is a good one to watch, especially if everyone's expecting a dividend. I know I am. I'm keeping a close eye on FCF for GME, which is free cash flow. It is the cash produced by a company through its operations minus the cost of expenditures. In other words, free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures. Now, we do know GME has some restricted cash on hand, which is good. Free cash flow shows how efficient a company is at generating cash and is an important metric in determining whether a company has sufficient cash after funding operations and capital expenditures to, and this is where it gets important, to reward shareholders through dividends and share buybacks. Free cash flow can be an early indicator to value investors that earnings may increase in the future. Since increasing free cash flow, and this is why this is a good thing to use, it typically precedes the earnings. So if a company's FCF is rising, it could be due to revenue and sales growth, or it could be cost reductions. In other words, rising free cash flow could reward investors in the future, which is why many investors cherish free cash flow as a measure of value. When a company's share price is low and free cash flow is on the rise, the odds are that the earnings and the value of the shares will soon be heading up, so you can get your titties jacked. And if anything, that's an important thing to take away from this right there. Look at the FCF. If it's rising before earnings, it's a good metric to see that, hey, maybe going up soon. So anyways, hope you found this video helpful. Next, I will help you learn how to trade a straddle, which is one of my favorite strategies to play on earnings. So stay tuned for that. Take it easy.